to capitalize upon an exponential growth opportunity. And they did it. We think that is going to happen increasingly during the next 5 to 10 to 20 years as these innovation platforms take off. And we do believe that blockchain technology is going to be an integral part of that, and particularly the convergence of these platforms. Blockchain technology and artificial intelligence, I think, is going to be particularly powerful. But to give you a sense of our relationship with Bitcoin, how we started, Colleen gave you a good introduction. Our involvement with it predates when we wrote about it first. It actually started when Brett Winton, our director of research, and I were at AllianceBernstein together. He bought his first Bitcoin at $7 and then was very proud to hold it until it was $100, which you can see on this chart. He sold it at $100 and was very proud of himself. So when I founded ARC, he was one of the first people I wanted to join, and we talked about blockchain, but we didn't include it in our first platforms, innovation platforms. We really wanted to know what we were talking about. We wanted to battle test it from a research point of view. So it took us about a year until we wrote that first paper that Colleen mentioned, Bitcoin, a Disruptive Currency. We wrote that paper in collaboration with Art Laffer. Art Laffer is my mentor. I don't know how many of you know Laffer curve. Yes, Laffer curve, supply side economics. So what many people don't know about Art Laffer, they know him for his tax policy. They don't know him as a monetary scholar. His mentor was Robert Mundell, who won a Nobel Prize for monetary economics. And so when he agreed to collaborate with us on that paper, first of all, I was thrilled because he had been asked many times to collaborate with people on such papers and had refused to do so. The only way he would do it was to make sure that he understood every single thing in it and could buy in. We originally had the paper set up as one very long paper. The original disruptive currency, and then network security was the second part of it. He said he couldn't understand the second part of it, and it was just too tech-oriented for him, so he forced us to separate it into one. And he really took us through the ringer. Now at this time, and I should introduce Yassine El-Mandra. Yes, Yassine is ARC's secret weapon in the crypto world. He's our crypto analyst. So we do have an analyst dedicated to crypto. We do think it's that important. And we're seeing investment opportunities in the public markets, Square prominently among them, Matt being here. And we think it's going to be increasingly important. When we wrote this first paper, Chris Burniske, some of you may know Chris, was the author in collaboration with Art Laffer. He took Chris and me through the ringer, and I think because of that, we both now understand Bitcoin a lot better than we would have had he not been a collaborator. But I remember at one point just sitting with Art and saying, as we were going through this paper, I remember saying, Art, how big could this be? And he said, well, you know, it's really interesting. This is the first time I've seen a rules-based monetary policy that makes sense to me. Now, I don't think it's the right rule. But rules-based, they'll get there. So rules-based, what he was saying was, this is a quantitative rules-based monetary policy, mathematically metered to top out at 21 million units. Great for store of value use case. Not great for means of exchange, which demands in some way price stability. Now, even Bitcoin is more stable in price than the Bolivar in Venezuela, but that's not where we're aiming to go here. And but what he said is, hey, I think they'll get there, and so I've been very interested in discussing that with anyone in the community over time. So we also took a position, and we were the first public asset managers to gain exposure to Bitcoin in September of 2015, when Bitcoin was $250. And we were fairly new. We had just started the firm. And I remember that one of the best known ETF journalists, and we had launched in an ETF, basically slammed us, saying, well, yeah, right, great marketing gimmick. And many people thought I might be upset by that, but I wasn't. I actually was thrilled. You know, if someone is just not even willing to consider and just slams us without, looking at why we've invested in it, clearly hadn't, then I know we're in such early days. So $250 to $20,000, we sold nothing until then. In the meantime, we wrote this other paper that Colleen mentioned, which was with Coinbase. And yes, being the first sharing economy company in the asset management world when it comes to research is paying dividends like I never expected. In fact, I believe that this is the way how most asset managers, especially if they're focused on innovation, are going to have to do this. The world is moving too fast. We cannot house research within one institution. It's going to become a very provincial way of thinking. So we are pushing our research into Twitter, LinkedIn, Medium, Telegram, any social network that will help our analysts engage with and become a part of the communities they are researching. That paper with Coinbase gave us data that we couldn't have written a paper about new asset class without that data. And Adam White, who is now president at BACT, of course, was the person we were working with at that time. Today, Yassine is working with Coinmetrics. I think I saw Nick Carter walk in somewhere. There he is. And I think and so it's going to be an extension of this paper and more. Because one of the things that we believe, and I learned recently at a meetup that I attended, is the biggest thing lacking in the institutional world is education. Knowledge is power, and so we want to make sure that we continue to blaze a trail in terms of educating. It's one of our missions as a firm is to educate. So Nick, thank you. We're really happy to be doing this and excited about publishing it. And then, not to belabor this too much, but we did end up better lucky than smart, I will tell you. And I'll get into it more when we talk about the different investment vehicles. But we did exit the bulk of our GBTC in late 17, early 18. And it was because it was for tax considerations and fiduciary responsibility. I'll get into that later. And then from an institutional point of view, what's been very exciting in the last year is, and I was shocked to be honest, I don't know if anyone from Cambridge is here, I wish they were actually, I was shocked to see that they had written a report. Consultants in our world typically don't lead in this way with innovation. And they did, and I just was thrilled to see that. And I think it's gotten a lot more investors in the institutional world to consider Bitcoin, rightly so. And then, of course, Fidelity's been on this for predating Cambridge, of course, with Abby Johnson mining in her office, and Fidelity now offering custodial services for institutional investors. which is also a boon for the institutional world. I know that Christine Sandler is going to be here. I don't think she's here yet, so kudos to Fidelity as well. We do believe that Bitcoin could be the most compelling alternative asset of the 21st century. And that's not an exaggeration. A new asset class, that's really something. So from a strategic point of view, it is an incredible portfolio diversifier. I can tell you that from experience, and we've seen in the early days when we had Bitcoin in our portfolio, when the European sovereign debt crisis was flaring and Greece was threatening to leave the European Union, Bitcoin would move contra to the equity market. So negative or neutral correlations, to be sure, and tail risk mitigation. I mean, if Greece had left the European Union, who knows what would have happened? It could have been 08, 09 squared or worse. And then appreciation potential. So today, the network value of Bitcoin, as you probably know, is about $165 billion. If we're right, there are three use cases here that today should be valued in the market. Today, the present value of these three use cases should be valued at $3 trillion. So this is about 20-fold higher than where we are right now. These are the use cases. So we know that in the emerging markets, there are a lot of problems. There's hyperinflation, which we know oh so well from Venezuela and now Argentina at 50% inflation. It's hard to believe. I have friends there. It's unbelievable that they're going through that. And they are using Bitcoin and dollars to protect themselves. So what we did here to gauge what that opportunity should be worth, this currency demonetization in emerging markets, we took the money supply outside of the big four, outside of the US, Japan, Europe, and the UK. And we said, okay, let's say 5% of that money supply, the value of that money supply, of that $40 trillion, will go towards Bitcoin as citizens of those countries understand what risk, they do understand what risk they face, because they faced it time and again. It's a roller coaster. Let's say it's 5%. I think that's conservative. Present valuing that, and here we account, we're using a 10% discount rate, and we're accounting for the dilution of Bitcoin as supply inflation takes place over the next few years. That alone is worth $1.1 trillion present valued, okay? We should be willing to pay that today if you believe that is a legitimate way of looking at this. Digital gold, store of value, 15%. Millennials don't want to own gold, right? And that's going to become increasingly the case. They want digital gold. That would be approaching another $1 trillion. And then the notion of confiscation of wealth. So here what we did is we took the number of individuals in the world with investable assets of $1 million, and we made the assumption that they will assume that there is a 5% chance in their lifetime of full confiscation of their wealth. So a 5% chance in their lifetime. And that opportunity is 1.3. So here you do see, here it is actually roughly $3 trillion. So we think, in other words, that Bitcoin is incredibly undervalued. There are many more use cases, but these are the three main ones. Now, why now? Well, from an institutional point of view, the infrastructure is starting to evolve and come into place. Backed Fidelity, Cambridge, and Square. with Square Crypto. I mean, this is one company now, and Bakkt is owned by Intercontinental Exchange. These are two companies now in the public markets where this actually could move the needle. And so to have an analyst dedicated full-time to crypto no longer seems like a waste from the public asset manager's point of view. We would never have considered it a waste. And then the asset seized. I mean, who could have guessed that MBS would have seized wealth from his own cousins, right? Wouldn't they have done better if they had just put 5% into Bitcoin, like that confiscation of wealth example, and just carried the keys in their head or something and across borders? And then, of course, we saw the India demonetization and the prospect that that could happen in other emerging markets. You can see that this is becoming a big business. The fees paid cumulatively to date are about $1 billion. The miner revenue cumulatively to date about 14 billion. Transactions cumulatively about 2 trillion. And daily active addresses 720,000. So, this is we're starting to gain critical mass here. Demand in the emerging markets is exploding. I think it's up tenfold in the last 2.5 years. This is more of a proxy for what's happening in Africa, what you see here. And then finally, this is my favorite chart. My background is economics, Art Laffer being my mentor. And this chart is pretty provocative. The share of countries' currencies losing more than 50% in purchasing power over 5 years. Now look at when that has happened. It happened when the Federal Reserve was established in 1913. So again, the dollar became de facto, or the beginning of the reserve currency. It happened again when the US confiscated gold in the 30s. It happened again in 1971 when the US went off the gold exchange standard. And it hasn't happened in quite some time, but now that we're going to QE infinity, and it's pretty unbelievable what's going on. And we're seeing issues in the repo markets and just kind of questions like what's going on out there. It would not be surprising to see another flare-up. Now, I think there's so much fear out there. The flare-up would occur, I think, if the velocity of money started to turn up. It has been falling for years now, certainly since 08, 09. And what that means is velocity going down tends to be anti-inflationary. It is when velocity turns up. And there is so much kindling sitting on the central bank's balance sheets right now. That's all kindling out there. And now again, it's growing. And I probably don't have to speak to this audience on that, the fear of hyperinflation. But in the traditional asset management world, nobody thinks that's possible. And it's usually when people think something is not possible that it happens. So even I just told you, velocity is going down. I don't see that happening right now. But these are the what do you call these? The black swans. Yes, black swans. It's when nobody expects it. So here again, we have credibility in the financial world itself. So Cambridge on portfolio allocation, Fidelity on custody services, Bakkt a benchmark for price discovery, Square support for open source development, which we think is one of the most important things to have happened to this space in a very long time. And what's interesting is this is not, when you read it, what Square's doing here, this is not in the short term for Square's gain. If anything, they're supporting open source away from the Square network. But we think it will be longer term. And Jack Dorsey moving to Africa for a few months this year is kind of proof positive, that he thinks there's something very big brewing here. Our investment philosophy, yes, we do believe that the soundest form of money will provide the most significant value creation opportunity for investors in this space. We do think that's the category killer. Now, what's been interesting, so we have the Silicon Valley view of this, and we have the East Coast view of this. And I think that's an important dynamic. Silicon Valley has gotten so used to, addicted to, scalable network effect opportunities, multi-sided marketplaces, features, functionality, faster, better, so forth, that's how they came at this world. On the East Coast here, we see more people focused on the money first, not the software first use case. And while the software first analysts or VCs will be focused on features, functionality, speed, and will consider Bitcoin's the slow processing of transactions to be a bug. Of course, the Bitcoin maximalists and others consider it to be a feature. And the fact that, and I have to be careful when I say this, I used to say all the time that the underlying Bitcoin blockchain has never been hacked. Well, at a meetup recently, I learned when talking to developers who are actually doing this on a day-to-day basis that there are bugs that do surface, but this open source community is so fiercely protective of it that we don't perceive any of these bugs as being a hack to the underlying system. What we do see are hacks in the applications on top of the system, but really no bug has infiltrated Bitcoin to such an extent that we would consider it, in our parlance, a true hack. So it is the most secure network out there, and that certainly is the most important feature from a money-first point of view. Again, here is basically saying what I've just said. The perceived moat in the software world is the feature set. The perceived moat in the money world is this security and the assurance of retaining monetary wealth. Again, a global battle among monetary systems is underway. And you can see this from Libra. So Libra has, it happened so much faster than I expected, but to be banned immediately from India and effectively to be banned from Europe. I guess I wasn't so surprised by an emerging market banning, because this is really a threat to their monetary systems. So that, I guess, wasn't surprising, but to see Europe come out and say, oh, no, not until we evaluate this completely will we allow Libra to be used in the European Union. And I don't know if there's been any modification of that. And I don't know if we don't know if Libra is really going to be successful at all because of this. But the reason Libra came under this kind of assault is there was one throat to choke. It was Facebook. And because Facebook, from a trust and security point of view, has become so out of favor, and it's popular among politicians to bash them, this was easy for them to do. So Bitcoin has no one throat to choke. And so, you know, but we're thrilled that the politicians are really focused on Libra. You know, it gives them a place to vent and say that they're doing something about this new monetary thing going on, when it's going to become pretty impossible to do that. And the longer it goes on like this, it will become impossible to do that with Bitcoin. So here, we do believe that Bitcoin is the likely winner for these reasons. And yes, the greatest Lindy effect. I'm back to, wow, really no serious hack to the underlying blockchain technology. That's what we want from our money. How am I doing on time? We're good? Okay, so I saw that the title of my presentation was this, and so I felt I should speak about it. No, I'm kidding. No, we actually agree with it. We actually agree with it. So assessing the crypto landscape, and you can see the crypto fund launches, and this is VCs and hedge funds. You can see they peaked in 2018, doubling down after the peak in the price at the end of 2017. So that's very normal to double down, you know, buy on the dip, buy on the dip. And now you can see they're basically exiting, and you know, we know a lot of them are shutting down. 20% of all the funds launched in, all the VC and hedge funds launched in 2018 were crypto fund launches. Think about that. That's crazy. Cross-investment we're seeing as a prevailing theme. Now, we are friends with some of the VCs you see here, but you see there's a lot of cross-investment between and among hedge funds, VCs, and this has been true since 2017, which has created, you know, the sense that there's been a lot more activity going on than there really has been, and it's created a bit of FOMO. This reminds me of the internet bubble, when companies were being created and their primary customers were some of the other companies that VCs had created. So it became very, very incestuous almost in terms of where the activity was being generated. There were no killer apps evolving in the early days of the internet, except for maybe commerce. But even that took a long time. So, we do think there is a mismatch between expectations and reality. The whole herding, FOMO, we would say a lot of malinvestment. Some of those VC a lot of those, the cross investments here include a lot of ICOs, which we think are going to be and are becoming, and many more will become worthless. And it's again this VC Silicon Valley way of looking at the world versus more the East Coast way of looking at the world. And the average crypto hedge fund manager wasn't even an investor during the internet bubble. They were 10 years old. And so, you know, they don't have the benefit of that experience. And, you know, I can tell you, it's like Wile E. Coyote. You know, if you went through the internet bubble, and you know all of these, it's Wile E. Coyote, and then you realize, boom, that was the crash. And you know, they didn't understand that can happen because they didn't live through that, and so they've had to learn the hard way. Are institutions set to capitalize on Bitcoin? Well, there are